So before we get into our main topic of the day, which is capital assets and accumulated depreciation, I wanted to touch on some updates. First is the ARPA, the revenue calculation video. Board of Accounts has recorded a video on the revenue calculation aspect of ARPA. Susan and one of our other directors, Lori Rogers, Lori specializes in counties, they made a recording to discuss what all goes into the revenue reduction calculation. That should be ready soon for viewing. We're right now dotting our I's and crossing our T's and getting all the approvals that we need. When that's available, we'll go ahead and send out a mass email to everyone who subscribes and let them know where they can view that. And we would recommend you take a look at that. We also have an update on interest. We distributed a memo regarding how interest is to be handled. And it differs slightly from what we talked about last month at this webinar series, where we said interest could be prorated between the ARPA fund and maybe a general fund. The memo was sent out on July the 9th, so last week, and it was dated July the 8th. So we're going to refer to that as the July the 8th memo. Basically, it reiterates that interest can be earned on ARPA money. We had that question, quite a lot of questions about that, how that could be handled, and you can earn interest on that ARPA money. It does not have to be in a separate bank account. It can be, but it doesn't have to be. And the interest earned on the ARPA money does not have to be remitted back to the federal government, as is sometimes the case on federal dollars if you're earning interest on it. That falls under the cash management compliance requirement, and that doesn't apply to the ARPA. So then your interest is to be accounted for in compliance with Indiana Code 5-13-9-6, which requires interest on investments to go into the general fund or another fund that's designated by the fiscal body by a resolution or within the written investment policy of your city or town. So again, that's Indiana Code 5-13-9-6, and interest, the ARPA interest will be handled how you handle all other interest. It either goes in your general fund or your council can designate a different fund for the interest to go into. Your slides, if you got them from what we sent yesterday, we've actually revised this slide that you see on the screen a little bit. So this link for the third bullet point may not be in your materials. And this information came in yesterday after we'd sent that out. So we're going to be revising the information on our website on the slide so that you'll have this link, because it's a really long link. You don't want to type all of that. But the Treasury has hosted a series of informational webinars for local recipients, and recordings of the reporting guidance webinars, along with the accompanying slides, are now available on the Treasury's website at that link. The next bullet point is on capital assets. In addition to what we're going to talk about today, we have released a video recording on capital assets. And you're going to hear some of the information today that's also in that video, but they are two separate things. And that video is on our YouTube channel. There are two ways to really get there. You can obviously go to youtube.com, and then you want to search State Board of Accounts Capital Assets. And there are a couple of videos. Some of them we did a year or two ago, but the most recent one was uploaded. I looked yesterday and it says 3 weeks ago. So look for that most recent one, is what I'm talking about. Or if you're not able to do that, you want to go to our website, go to the city's page or the town's page as you normally would, and scroll down to the presentation materials. And the very first thing there is our YouTube. It says YouTube channel. It's our link to our YouTube channel. You can click on there, and it will take you to all of our videos. And again, you can, once you're there, you can, within that playlist or within that page, you can search capital assets, and you should be able to find the video that I'm talking about. And finally, we wanted to update you on our training that's going to happen between now and the end of the year. Talk about those a little bit. The next time that you'll see us will be August the 27th at the League's Fall District meeting. Then in September, we'll be back doing our monthly training, so that'll be on September the 22nd. A couple weeks after that, Susan and I and our board will be at the AIM Ideas Summit down in Fritz Schlick. That runs from October 5th through the 7th. We will be there on the 6th, October 6th, with a resource table. So if you've been down there and seen that before, or been to the Idea Summit and seen us, we just have a resource table set up with Susan and myself, and usually Debbie Gibson, who's another director of audit services, and our board will be there as well. And I think Susan and I will also be there on the 7th. Not really at a resource table, but we'll make ourselves available to mingle around and sit in on some of the presentations that are going on in the different classes. So you can catch us one of those 2 days. Then November the 8th will be the league's annual conference. It's going to be in Evansville this year. It's part of that week, but Susan and I will be there on November the 8th. And then we'll round out the year on December the 15th with our final monthly training session. So getting into capital assets and accumulated depreciation, we've discussed the changes that have been made to the enhanced annual financial report. Some of those changes have been delayed past the time we had originally expected them to be implemented. We had COVID and some other things come into play that pushed that back. But now, as we move toward our new normal, we are moving ahead with implementing those delayed changes. Capital asset schedules will move from a supplemental schedule to a note in your financial statements. The capital asset schedule will include the beginning balance for the year, additions during the year, deletions or reductions in the year, as well as the ending balance, all in a note. The notes of the financial statements are an integral part of the financial statements, and we do place an opinion on those notes. So that's part of the overall financial statement that we place an opinion on. There's also going to be a schedule of accumulated depreciation that's going to accompany the schedule of capital assets in the note disclosure. While you've always had to maintain capital asset records, you've not been required to maintain an accounting of accumulated depreciation, unless, of course, you have GAAP financial statements, and that is a requirement for financial statements presented on the GAAP basis. For enhanced regulatory and regulatory, you've never had to do that before. But now the enhanced regulatory report is going to require the schedule of accumulated depreciation. So we're revisiting this topic today on capital assets, talking about accumulated depreciation, and then later Susan's going to go over some like real world type examples. Capital assets is an accounting concept. From GASB 34, capital assets includes the types most common in cities and towns being land, infrastructure, buildings, improvements other than buildings, machinery, equipment, and vehicles, all as one category. And other assets like historical items with significant value. For example, maybe you have a museum. Works of art can also be included in that other assets area. Also, construction in progress is recorded. That's construction of something that will be a capital asset when it's completed. So these are all common expenses that will last for more than one reporting period. On this slide, I copied the information from our Accounting and Uniform Compliance Guidelines Manual for cities and towns regarding capital assets. This is guidance that has been in effect for some time now. You've been required to have a capitalization policy and maintain capital asset listings. You could have, and some did, some places did, receive a comment in an audit report if there wasn't a capitalization policy or a detailed listing of capital assets. The capital asset summary amounts by category at year end used to be included in a supplemental schedule in that audit report. However, we didn't audit the accuracy of the capital asset detail, nor did we place an opinion on that schedule. In the future, we're going to do both. We're going to audit capital asset records and place an opinion on that schedule. From the manual, we find we should have had 3 requirements that we were meeting. The capitalization policy is the first one. This doesn't have to be a long, detailed policy. We've talked about it in the past. It's a threshold over which purchases of different types of items will be capitalized or considered a capital asset. We've talked about it. If you were at the annual conference a few years ago, Mike Nielsen spoke about the capitalization threshold. And just as a side note, Mike is coming back he'll be at the annual conference in November as well to talk more about capital assets. But you need to set a reasonable threshold for capitalization, and that works for you. There isn't one right answer that applies to everybody. All cities and towns are so different and have different setups and different organization hierarchies that what is a threshold in one place might not work at your location. So you need to know and figure out what's best for you. If you set that threshold too low, you're going to set yourself up for a lot of work that may not provide a lot of benefit. There are many small purchases that are useful for more than 1 year, but tracking down every last stapler is going to give you nightmares if you have to do that. So, tracking a stapler is kind of an extreme example, but kind of wrap your mind around that concept. If the value of an asset is relatively low, it's really not worth your time to account for it as a capital asset beyond the year of the purchase. However, you want to keep in mind, you want to set your threshold too high so that you're not capitalizing a material amount of assets. If you set your threshold at $100,000, for example, you probably won't be capitalizing many of your vehicles and equipment that fall below that threshold. That's not to say for a large enough entity, $100,000 wouldn't be reasonable. However, just keep in mind that threshold has to make sense for your city or town. It's also a good idea to have a schedule of useful lives by category. We're going to be discussing categories of capital assets and some useful lives for each in a bit. A useful life is just an estimate. It doesn't mean that if you sign a useful life of 5 years to an asset like a vehicle, that it's definitely going to fall apart in that 5th year, or even that the vehicle has to be taken out of service after that 5th year. Again, it's an accounting concept to allocate costs, and the estimate is your best guess on how long an asset's going to be in use. At the end of the useful life, it will be fully depreciated, even though it might still be in service. So these useful lives certainly aren't an exact science. Once you have the capitalization policy, you need to list all the items that are above the threshold. Hopefully, you already have your detailed listing of capital assets on a prescribed form or one that maybe your computer system provides. And we're going to look at that prescribed form here in a second. As a side note, and a matter of clarification, we're talking about capital assets today, those items over your capitalization threshold. Don't let that be confused with a listing of small but sensitive items that you might have, like tablets or cell phones, laptops, chainsaws, anything that might fall below the threshold but could be at a higher risk of misappropriation. These types of items aren't going to be capitalized, but you still need to have controls in place so that they're not misappropriated. An inventory of those kinds of items can serve more than one purpose. On one hand, supporting financial reporting, and on the other, safeguarding of assets. We talked about that in previous presentations, maybe going back 2 or 3 years, where we called those walkaway items. And if you have questions about walkaway items and how to account for those, or where that presentation is, shoot us an email and we can point you in that direction. And the manual does call for every 2 years, a physical inventory needs to be completed to verify that the listing of capital assets is accurate and complete. If you have strong internal controls over your capital assets, your inventory should come out and not have many issues. But for our experience with most cities and towns has been that departments are not really proficient at updating that capital asset listing, especially when they get rid of something. You might be the last person to know when a parks department gets rid of an asset, and it may be months or years later before you get that information and are able to get that off of the asset listing. So those controls in place can be very important in assuring that you get the information you need to keep on the asset record. If you keep a listing of your equipment by departments, you can copy off the detailed list of assets for that department and have the department head or some designee take that physical inventory and compare it to the list. And they'll add any missing assets or remove any assets that have been disposed of. They'll add anything that they're counting that isn't on that list, and they're going to remove, that old truck or that item that they got rid of and they forgot to tell you about. So this is what the current prescribed form for capital asset ledgers looks like. It can be kept by fund and or kept by department. You don't have to use the prescribed form, which is a handwritten form, if you've got an alternative form or software that's going to provide the same information. That alternate form or software report would have to be approved, but you can use the alternate form even before the approval, as that approval is going to come during the course of an audit. Chapter 1 of the Cities and Towns Manual provides a process for getting alternate forms and reports approved. And since everybody, if they're using, based on their system or a form they've developed, they could all be different. Just for the purposes of today, we're going to focus on the prescribed form and what it calls for. This form captures the date of the purchase or the acquisition of an asset. The date is important as the accumulated depreciation is going to start with the year the asset's acquired. Then you're going to record a description of the assets, and that description needs to be unique enough to describe it. If the description is just a truck, that's probably not sufficient to identify which particular truck that is. If you don't include the year, make, and model of the truck, you need to provide more accurate information. So when that truck is sold or traded off, that you'll know which line to record that disposal on. Serial numbers or VINs are important and can be a part of your capital asset record. It can even be a serial number applied by your city or town. So maybe you've seen asset tags. You have your own tags manufactured that you'll go affix to a capital asset item, and it has it's pre-numbered, and so you apply that and you would note that number on it. Or if it's something like a vehicle that already comes with a serial number or a VIN, you can use that, or both. Again, that's all going to provide the detail to identify that particular asset for inventory and disposal recording purposes. Form also wants the location of the asset. That's going to help identify it. Is it a park asset? Is it a street department? Is it in the clerk treasurer's office? Is it the mayor's vehicle? Those kind of things. Original cost is an important value to have. If you're in the unfortunate position of compiling a detailed listing of assets on hand, so you don't already have that and you're putting that together for the very first time, you're going to be including many assets that were acquired a long time ago, like your town halls, the land where the city park is, etc. However, you're still going to need to record those as accurately as possible. And we'll discuss estimating the cost of an asset in these cases here in a bit. Once your asset listing is up to date going forward, all your additions should have invoices or a claim or a contract or some documentation that's going to provide the original cost of the asset. Estimated useful life is important for determining accumulated depreciation, and we're going to be talking about accumulated depreciation here in several slides. It's also a place on the form to record the date of disposal. That's an important piece of information to have. And it's also missed in a lot of capital asset listings that I've seen over the years. I've been places that's had equipment and vehicles that were no longer owned. They had been disposed of, but that asset was still on the ledger because it hadn't been updated to reflect the disposal. There's a place for an amount received in trade-in, but that's really only going to be important for those units that are compiling GAAP statements. For enhanced regulatory, just the asset costs and the accumulated depreciation are going to be the important amounts to record. The original cost is then allocated to the appropriate category of land, infrastructure, buildings, improvements other than buildings, machinery and equipment and vehicles, and books/other, far right column. Susan's going to be going over an example of what this form might look like in actuality. Let's talk about some of those different categories, and we'll start with land. All land should be capitalized, no matter what the acquisition cost is, unless it's land that you're purchasing for resale and it's part of an inventory, like maybe your redevelopment commission has land that it acquires and then turns around and sells, or if you have a land bank. But all other land owned by a city or town is capitalized. And land's usually associated with another asset. For example, the land under City Hall, the ground under a public parking lot, the land and easements for a street, or even the land used to create the town park. Sometimes a city or town owns land that is not for specific use, and yet it might be leased like for farmland, and that land still needs to be capitalized. Land is always separated out from the other assets, so land under a building is posted to the ledger as land, and the cost of the building is reported separately under buildings. The location and amount of land, as well as the date acquired and purchase price, should be included in the capital asset record. Also, try to include some information regarding the acreage or the size of the land. And if the land is donated to your city or town, the fair market value at the time of the donation should be the amount that you record as the capitalized amount for that land. If you don't know that, you may want to have some kind of valuation performed, or get an estimate or information from somebody that would know what the value of that land would be, and just keep that documentation and record that on your asset ledger. Now, land doesn't wear out for the most part, so land has no estimated useful life or depreciation to accumulate. It isn't used up as part of your municipal operations. And although in the political world, where we hear what is happening to the planet, how long we've got left, before things go south, in the accounting world, land is assumed to have an indefinite life. Land doesn't wear out, not used up, like I mentioned. It's not depreciated, and there will be no accumulated depreciation to report for land. Infrastructures are the systems that support a city or town's operations. These are going to be things like your streets and alleys, bridges, stormwater and drainage systems. Even communication networks could be part of your infrastructure. It's also going to include utilities, so your electric, your water, your wastewater distribution systems are all part of your infrastructure. Infrastructure items tend to last longer than some of the other assets, and they tend to be non-movable. So streets and sewer systems can't be moved without a whole lot of work and equipment. So they're, that's the first clue if it falls under infrastructure is, can I move it or not? And valuing infrastructure can be tricky. These types of items were usually acquired over a period of time. Not all of your streets and bridges are the same age, and for very differing costs. However, for streets and roads, LTAP or your street department personnel, even a council member, might already have records and track the number of miles of road and the age and condition of them. Most of you have an asset management system that's required in order to even apply for a community crossings grant, and that plan likely has some information to help with valuing the streets and roads. And LTAP has also developed some software that helps categorize and assign costs to the streets, and it can track accumulated depreciation. And if you're not familiar with the acronym LTAP, that stands for Local Technical Assistance Program, and it's operated with assistance from and through Purdue University. They deal with local units on street and road issues. If you need more information from about LTAP, you can shoot us an email, and we can provide our contact information. Buildings are more permanent structures on land. They don't move, but because they're non-movable, they are different from the infrastructure that we just talked about. So think of your town hall, your street department garage, the buildings at the city park. Those types of things are going to fall in the building category. Your capital asset list should indicate the location of each building, the acquisition cost, and whether it was purchased or you constructed it, and any improvements to the buildings, like add-ons. You added on to a park building, or you did a major renovation by adding a second story to a building, something like that. This is a category where additional capital costs versus repairs can come into play. If you're significantly extending the useful life of an asset or the use of an asset, like additions to a building, you would need to capitalize that cost. But if you're maintaining the building in its current capacity, those aren't going to be capitalized expenditures. So if you're painting the building, or you have to point some brick on the exterior, or you put a new roof on a building, those are maintenance type items, and those costs would not be capitalized. The useful life of buildings is often very long. Buildings are mostly built to last, so they have long lifespans, could even be approaching 50 years or so. Again, when you hit the last year of that useful life, it doesn't mean that you have to move out of that building. You can still use it. It'll just be fully depreciated by that time. I mentioned this earlier, but the estimated useful life needs to make sense for your city or town. It may be the average time before the building has outgrown its usefulness, or it needs extensive renovations to continue to be useful. Use the lifespan that seems appropriate for you, and based on how the building is going to be used, the quality of the building, and how well it's being maintained. Improvements other than buildings are improvements to land that add value but don't have an indefinite life, like land does. These are not buildings, as the name may suggest. These are things like parking lots, fences, landscaping. They're not permanently attached to the building themselves, but they do have a useful life of more than a year. And often that useful life is going to depend on the type of improvement. I did some internet searches and found that parking lots and sidewalks can have varying useful lives depending on whether you use concrete or asphalt to construct them. Fences as well. A metal fence may last longer than a wood fence. Trees can even be capitalized as improvements other than buildings, and a tree may last hundreds of years, or a storm may come through and wipe it out in a couple of years. Equipment and machinery is up next, and it also includes vehicles in this category. And these are the ones that change the most from year to year and have the shortest useful lives. So here we're talking about machines, trucks, cars, road and street equipment like maybe a bulldozer or a grader. You could also have electronic equipment, computers, computer servers, safes, office furnishings, office equipment like scanners or copiers, or large tools. Again, I mentioned earlier, if there are smaller items that are at a higher risk of misappropriation, like electronics or smaller types tools, you want to use an inventory system to track and account for them to ensure that they're not walking off. But this would not be part of your capital assets. That's these smaller items below your threshold. Now, GASB, and you've heard me say GASB a couple of times, that stands for the Governmental Accounting Standards Board. They set a recommended practice that the threshold will be set at least $5,000. It can be set higher depending on your needs, could be $10,000 or $50,000, anywhere in between. Review your detailed listing, and if there are numerous smaller items, you might want to consider raising your threshold amount. You typically don't see thresholds for equipment that are less than $5,000 unless there's a good reason documented for the lower threshold. And different equipment can have different thresholds. You could have a threshold or a capitalization policy for just computers, and you could have a different one for vehicles, or you could have one that just covers all equipment. It's up to you and whatever works, in your community. Equipment purchased with federal dollars requires a little extra attention. If you're buying equipment with federal dollars, you need to identify that separately on your ledger, and you need to identify it separately as a federally purchased asset. This might be a bus for a mass transit system. It could be police department, capital type items. All of these types of assets have additional requirements for use and disposal per the grant agreement. And they need to be tracked in order to be part of the compliance with the federal grant program. So as an example, let's say your capitalization threshold is $7,000, but you have a particular grant that requires you to track any assets purchased with the grant funding that exceed $5,000. You're going to need to track any items between 5 and 7 that you purchased with federal dollars in order to be in compliance with the grant agreement. That's going to differ slightly from reporting in the annual report. Your capital asset schedule in your notes, and for financial purposes, would be any items. Those types of federal dollars in that example would not be on your annual report. So if you used a federal grant to buy a piece of equipment for $6,000, which is more than the grant agreement amount of 5, but less than your threshold of 7, you would want to identify that on your ledger as being purchased with federal dollars. You have to track it for your grant compliance. But when you got to the annual report and putting that on your capital asset schedule, you wouldn't want to show that because it is below your threshold. Typically, we see general equipment with lives around the 5 to 10 year range. A police vehicle may have a shorter life than a vehicle that's used by the town manager, for example. So you can set the useful life in accordance with the use of that equipment and the probable wear and tear on it. Your department should have a pretty good idea of what the average life of their equipment is, or even your vendors can sometimes provide an estimate of when the asset would need to be replaced. During the audit, we're not going to question you about using 5 years instead of 7, as long as the estimate is reasonable. I know there are a lot of trucks on the road that are over 50 years old and have been lovingly restored by their owners, but trucks in government service don't last 50 years. So if you had a 50-year useful life on equipment, we're probably going to ask some questions about that. Books and other types of assets. This category is new, and you are going to see it on your annual report when you're in Gateway doing that at the end of the year. However, most of you will never use this. This is typically going to be used by libraries to report their books and materials that they circulate. But a city or town could have a historical collection of books, and if they do, it can go here. Other types of items that have indefinite lives include museum or historical collections, artwork or art collections that you might have. If your city or town has a historical museum that you own or an art collection, and the purpose of that collection is to display or for research, and the collection is being maintained, and proceeds from the sale of any item in the collection is used to purchase new items for the collection, you are not required to report or value those collections. You can if you want, but you're not required to. If you do include those in your capital assets that you report on your annual report, there would not be a depreciation cost associated with that collection. Again, it's very unlikely that you'll need this category, but we wanted to cover it just in case. If you have something that you think might fall into this category and you're not really sure about it, again, shoot us an email and or give us a call and we can talk through it. Construction in progress is our next category. And in situations where an asset is being constructed, such as a park building, your town hall, or other types of construction, it's necessary to capture the cost of the construction during the construction period, even if that period lasts more than 1 year. You might start work on a new town hall in September, and you've got a certain amount of work done by the end of the year, but it's going to be another 6 or 7 months into that following year before it's done. Well, you don't want to ignore those costs between September and the end of the year when the construction started. You want to record those costs as construction in progress. The accumulated costs are held in this construction work in progress category until the project is completed and placed into service. At that point, the accumulated costs are then transferred to the appropriate category of assets. So you'll move them out of construction in progress, and you're going to move the appropriate cost to infrastructure or building or whatever the case may be. And then from that point on, depreciation will start to accumulate. During the construction phase, you're not going to recognize any depreciation. So if you have something that's constructed, maybe you start at the very end of 1 year, and construction continues through the next year, and it doesn't get completed maybe till the 3rd year. In that 2nd year, when it was completely in progress, you're not going to record any accumulated depreciation. It's not until you place the asset that's being constructed into service. Capital assets are valued at their acquisition or historical cost. In enhanced regulatory reporting, the purpose of the capital asset listing is not to report how much the assets are worth, like the fair market value or replacement cost. Rather, the purpose is to report the historical cost. So I mentioned this earlier. If you're trying to put together your capital asset listing from scratch, or you have a lot to add to it, you're going to find that there are several assets that were acquired sometime in the past, and finding the historical cost might be challenging. For your equipment or machinery and vehicles, hopefully you have claims or other documentation that can provide that acquisition cost. Land and buildings that were purchased 50 to 100 years ago are going to create a problem. You can look for any documentation like old deeds for land or old board minutes, even word of mouth to determine maybe how long you've owned a particular asset. If those sources don't provide the historical cost, there are ways to estimate the historical cost. And one way is to determine the current cost of an asset to replace it. And then using the consumer price index, you can calculate and estimate the cost at the year that the asset was acquired. The current consumer price index and method of calculation can be found in the June 2020 Cities and Towns Bulletin. And we revise that every year, and so the revised schedule is going to be in the September bulletin. So if you can hold off until September, we'll have the new calculations and formulas for you to use. But if you're doing it now, you'll want to look in the June of 2020 bulletin. And when you get there to the June, or even if you wait until September, this is what it's going to look like. This example in the middle that's highlighted shows an asset with a current value of $76,000 that was constructed in 1930. So the replacement cost of this asset in today's dollars is $76,000, but you know that's not what they paid for it back in 1930. So you go down to the chart and you look for 1930, and the index is 0.07. So then you want to take the $76,000 and multiply that by the index of 0.07 to come up with a value of $5,320. It's going to be that $5,320 that you're going to record on your asset ledger for this particular asset. And if you're doing this and you have any questions, please let us know. We'll try to walk you through it and help you with that as much as we can. Once you have the asset listed with the acquisition date, description, and acquisition costs, you need to assign the useful lives. We've already discussed some ideas for useful lives for the various categories. However, remember, there's no absolute answers for this. It's an estimate of how long that asset's going to be useful to your city or town. It can be helpful if there is a range set out in the capitalization policy to set the guidelines for various categories, as I mentioned before. However, your own experience with similar assets is going to provide very useful information. How often do police vehicles need to be replaced? How long does a piece of street equipment last? What about computers and electronic equipment? How often are you replacing those? Maybe you thought electronic equipment would get replaced every 10 years, but you find that after the 4th or 5th year, your laptop's not working and it's got to be replaced. So maybe that 10-year useful life needs to be adjusted down to what you're actually seeing in reality. Engineering estimates used to plan projects can also provide useful information. If you're working on a new town hall project, part of the estimate of the costs and options may be an estimate of how long a building that size will last or will be sufficient for your needs. You can also check with other cities and towns and see the range that they use in their capitalization policies. And this may be a great way to get some information if you're starting from scratch and you don't really have much asset information and you're really at a loss of how to go. Call up your neighboring clerk treasurers or controllers and ask them how they value or how they estimate useful lives. What information did they use? Did they find something online? Did they just look at their past history? It can be a great source of information. You can also find accounting guidance online. The IRS has some guidelines sometimes, or any other publications. You can do a Google search of useful lives and come up with all kinds of information. You're going to want to keep documentation of how you made your estimate for the useful life. And again, as long as it's reasonable, we're not going to have an issue with it. But you do want to keep that so that we can look at it if we have any questions or issues. Depreciation. This is the new area that you've not had to calculate or track before, unless, of course, you had GAAP statements. Depreciation is the mechanism for allocating the cost of the useful life of an asset. There are many different ways to do it, but what I think is the simplest way is the straight line depreciation approach. And to compute straight line depreciation, you take the cost of an asset, you divide that cost by the number of years in the useful life estimate. So each year then is going to get an equal portion of that cost. The only slightly complication in the straight line depreciation is determining when to start accumulating, when to start calculating it, because most assets aren't purchased on January the 1st and most aren't disposed of on December 31st. So when an asset is purchased partway through the year, how are you going to handle that? You have to determine how much to depreciate that first year or not. It's best if a policy is established in writing for this and included in the capitalization policy. An example might be, you might say any asset purchased between January the 1st and June the 30th would receive a full year's depreciation that first year. And then any asset maybe you purchased after July 1st to the end of the year would only receive half a year's depreciation that first year. Or your policy might be that any asset that's purchased after July 1st won't be depreciated until the next calendar year. So let's talk about an example. If you purchase a truck for $50,000 and you set an estimated life of 5 years. To determine that depreciation each year, you're going to take the $50,000 and divide it by 5 to come up with $10,000 a year. So what this means is that we're recognizing $10,000 of the cost of the truck each of those 5 years. If that truck happened to be purchased between January the 1st and June the 30th, and those are the dates I used in the example, they can be whatever you have, but if it was January 1st to June 30th, year one, you would still show $10,000 of depreciation if that was your policy. However, that same truck, if you bought it in August, and your policy was only to take half a year for purchases after July the 1st, then you would only recognize $5,000 in that first year instead of $10,000. So what would happen in year one, in that example, you'd show 5,000, and then in year two, you would show 10, 10, 10, and 10, and then 5,000 that final year. So you had recognized all $50,000 of that purchase price. For the enhanced regulatory, depreciation expense will not be reported on the financial statements, but we are, however, now accumulating the depreciation so that we know where we are in the use of the asset. So for our truck purchase in the first half of the year, in year one, we would have accumulated $10,000. And like I mentioned, each year that accumulated depreciation would increase $5,000 until that last year when it was then fully depreciated. So each year that depreciation expense is the same $10,000, but as we add to the accumulated depreciation, it increases. So your accumulated depreciation in this example in year two is the $10,000 from year one and the $10,000 for year two. So your accumulated depreciation at the end of year two in this example is $20,000. For year three, it's another 10, so it's accumulated as $30,000. For a truck purchase in August, and accumulated depreciation in year one would be $5,000 if we took that half, if that was how you had it set up. In year two, you're going to add $10,000. So at the end of year two, your accumulated depreciation for this truck would be $15,000, the 5 plus the 10. Year three, you're going to add another $10,000 to it. So your accumulated depreciation at the end of year three would be $25,000. At the end of year four is going to be $35,000. At the end of year five, it's going to be $40,000, but you're actually going to go into year six to take that final half year of depreciation, and it would be $5,000 you're adding to it in year six to come up to your fully depreciated $50,000. Your accumulated depreciation schedule is the summary of this calculation for each of your assets in your asset detail, with the exception of land and construction in progress, which don't have depreciation. As we stated, the accumulated depreciation schedule is a summary of the depreciation for all assets that's being depreciated. Beginning balance would tie to the ending balance from the previous year. The first year that you present the accumulated depreciation is going to be the most complicated for the beginning balance, as you don't have a prior report to rely on. Going to have to calculate the beginning balance of accumulated depreciation as it would have been had you been accounting for depreciation all the time. But we'll get back to that concept, and you'll see that in some of the examples Susan's going to go over. Additions to accumulated depreciation represents the depreciation expense for that year, which is being added to accumulated depreciation. This is going to come from your depreciation schedules. Unfortunately, we don't have a prescribed form for tracking depreciation at this time. However, you can use a spreadsheet. Sorry about that. You can use a spreadsheet to accomplish that. Reductions will be from the removal of accumulated assets for any assets that were disposed of during the year. So when you sell an item or you remove an asset from the detailed listing, you're also going to remove the accumulated depreciation that goes with it. The ending balance of accumulated depreciation can be calculated from the other three columns on your list. You've got your beginning balance plus your additions minus your reductions is going to equal your ending balance. You'll be able to visualize that a little better when Susan goes through some of her examples. Your additions to capital assets. So now you've got your assets all set up from prior periods and you're ready to progress forward. Getting your assets compiled is the hardest part. Once you get there, it's not too bad. Going forward, it's just getting started. You can now look at the current year purchases or construction. You need to have procedures in place to capture the purchases during the year that need to be added to your ledger. Procedures can vary from place to place depending on your staffing resources, your software, or others resourcing issues. Some places will flag all claims over the threshold and review it at a later date. Some places will have software that will capture that information on the purchases from over the threshold amount, and they'll produce a report at any time, and then you can add those assets to the ledger. Most claims will come from capital outlays classifications, although not all capital outlays will need to be added to the capital asset ledger. So if your capital outlays, start with like in the 4,000, have a number 4 in the beginning of it, that's a great way to go back and review anything that's from that capital outlay. And you might see many things that are capital assets, but there might be things in there that, even though they're posted on your system to a capital outlay, they may not actually be a true capital asset. So you just have to review those. During an audit, we will often scan the ledger for disbursements from capital outlays that should have been capitalized and test those to your detailed ledger to look for completeness. Some municipalities use a capital asset addition form and give it to each department to complete and to attach claims for the purpose of items over the threshold. And I hope it goes without saying, even though I can't go without saying it, you need internal controls to ensure that whatever procedures you've established are being followed and are working to provide accurate and complete capital asset additions. In the same manner as additions, deletions have to be posted to the capital asset ledger. This could be a little more problematic because you don't always have any documentation when an asset's disposed of or sold. If the asset is traded in or a vehicle is disposed of, you might have the title file. You might have that to look at, but if equipment is just outright scrapped or it's sold at auction or it's otherwise disposed of, you may not have the records that you need. For those trade-ins, the capital asset addition forms can have a place to list the trade-in information and hopefully sufficient detail to remove the asset that's being traded in from the list. You can also look at board minutes. Will sometimes have information on disposal of assets because large disposals of equipment or even the approval to take some things for scrap gets discussed in a board meeting, and maybe you've noted that in your minutes. Finally, the biannual inventories can weed out the assets that no longer belong to you. You print out a department's assets and have them review it annually or biannually for any disposals. That can help keep your asset records accurate and complete. And then the last bullet point, those clever little internal controls managed to sneak into another slide. You need controls to ensure that the procedures are being followed and producing the appropriate results for your disposal of assets and getting those accurately recorded. You may have heard the term book value before. This is the asset value less the accumulated depreciation. Again, this is not market value, but it's the carrying value on your books, hence the term book value. Why do we need this information, or what does it add to the financial statements? There are a couple of common questions. Well, knowing how much a city or town has invested in capital assets provides more information than just cash balances. It's why capital assets are required to be included in GAAP statements, a net of assets. Accumulated depreciation also shows how old your assets are as a class and as a whole. If your assets are 3/4 depreciated, you're going to need to start replacing them soon. Maybe if they're only 50% depreciated, your city or town is keeping a good balance of new and existing assets. So, for example, if a reader of your financial statements looks at your notes and sees that you have $100,000 of assets, but your accumulated depreciation is $750,000, then they know your assets are 3/4 depreciated, and you're going to have to take some action soon to replace those things. You're going to have to use cash or obtain debt to replace your items, and that can have an impact when a reader is looking at it. So that's part of the reason this information is being added to help give the reader a better idea of where you are with not only your cash balances, but your assets. If you're going to have to go out and buy a whole bunch of new assets, even though you have all this money in your general fund, or one of your other funds, then that looks really good. A reader can know, well, they're going to have to use some of that probably to go buy new assets. So again, by adding some of these GAAP components like accumulated depreciation to your financial statements and notes, we hope to bridge the needs of financial statement readers and the resources of the units that we're auditing. Then one last thing before I hand it over to Susan. As I mentioned earlier, a physical inventory should be completed every 2 years. This is especially important for equipment and vehicles. Buildings are fairly easy to count, normally don't walk off, but you'll need to make sure if a building or land was sold, those assets have been removed from the capital asset detail report. And I kind of touched on this a little earlier, but conducting an inventory, how do you do that? You can print out the listing by department, have your department heads go around and look for things on the list. You can have one person go around and count capital assets depending on the size of your unit. If you're a smaller town, maybe you can do that, or maybe the town manager can just go do that inventory. It's just going to depend on the resources and staffing that you have. And as I've mentioned before, those smaller type of items that are sensitive, it's always a good internal control for safeguarding the assets that do a physical inventory. So with that, I'll turn it over to Susan for her capital asset examples.
Well, good morning, everybody, and thanks, Todd, for that good foundation for understanding this next example that we have. What I'd like to do now is go ahead and walk through the completion of the capital asset ledger, just so that you can get an idea, if you don't have one already, on how you put that assets on the ledger, because that's the first step in being able to calculate your depreciation and accumulated depreciation. And so we'll also go through how to calculate that. Especially want to make sure that you understand how to get a good balance for your accumulated depreciation as of December 31st of 2020, because you're going to need that number as your beginning balance for 2021. So I want to make sure that you're prepared for that. We'll also talk about what the AFR is going to look like this next time for the capital assets section, and then look at the note for capital assets. So we'll go ahead and get started with that. Todd, if you want to change the slide over. This is my town of Toddville, our capital asset ledger for 2020 and 2021. And this is the chart I'm going to be working off of over the next several slides. So if you print off the material, you'll just have this chart. You won't have all the additional slides with the highlights, but I just wanted to kind of keep you from having to print all of that out. As Todd said, when you're entering this information on your capital asset ledger, you're going to go ahead and write in the date of purchase, your description, any kind of identifying number, where the asset is located, how much it cost originally, whether you have that paperwork or you have to estimate that, what the useful life is, and so on. So that's the information that we'll be looking at here. Okay, Todd. Okay, so for the first couple of assets that I want to go through on this, we have a town hall in Toddville and we have some land. The original cost of that asset I didn't know, but I had to estimate that based on the consumer price index tables, and I estimated that at $400,000, and I kept that documentation for audit. Also with that, we have the property that the town owns of $100,000. And you can see that I just went ahead and entered that under building and under land, and then that carried on across to total fixed assets. Next slide. This next group of assets that are highlighted here we have a fence for our park of $5,000 that would go into improvements other than buildings. We also have a Ford pickup truck, VIN number 1, for $25,000. That goes into machinery and equipment. Under that, we have another pickup of $40,000. We like to drive pickups in Toddville. Next, we have our Main Street It's a beautiful main street. That's why we like to drive the pickups. And we just recently redid that in 2019 with our CCG money, and that was $2.5 million. So I know the cost of that. And then we have another pickup truck there at the bottom, the Dodge, for $50,000. All of these were fairly new assets, and I was able to find the actual documentation so that I did not have to estimate the historical cost. But if I didn't have that, then I would have to come up with a reasonable basis for estimating that. Okay, next slide. And then the last asset I have on here that I wanted to talk to you about is our pole barn project for our park. In 2020, we had construction costs related to that pole barn of $40,000. So I put it into construction in progress because that barn has not yet been completed. And again, that carried on over. Next slide. And on this slide, this just shows you my capital asset ledger for 2020. I have all of my assets listed there. I have them categorized in various types of capital assets by original cost, and then that totals over to my total fixed assets. Now, the capital asset ledger form does not have a total line. You can put a total line in there if you want to. I like to, just because that way I know exactly where my numbers came from when I enter that information on the AFR. But certainly you can do that, or you don't have to do that because it is not part of the form. Okay, so that was 2020. For 2021, this is a little easier because I don't have to estimate the historical cost because now I have all of my paperwork. And the two things I wanted to talk to you about here are the town hall parking lot that we just put in 2021 for a cost of $15,000. So I'm just going to go ahead and put that in improvements other than buildings. And then we bought another pickup truck of $70,000. So I'm adding that to our machinery and equipment, and that will carry on over. Those two were pretty easy. Next slide. On this next slide, in 2021, I wanted to talk to you about the pole barn. We did finish that in 2021. So I had to move that out of construction in progress. And I also had $10,000 of additional costs. So you can see how that moved from construction in progress to buildings. And then I added the $10,000 for the additional costs. You may not want to do that in two lines. You might want to just do it in one line and put $50,000 in buildings. I just did it that way so that we could see it for the example. Okay, and on the next slide, in 2021, we sold our #1 pickup. So you can see that I had to go down in my total lines, which again are not part of the form, but it would be fine if you wanted to do that. I had to go down and take off the historical cost for that truck. I had to put that in my deletions, or also called reductions, column for the year because I sold that pickup. Okay, next slide. Okay, so on this, we just want to show you the totals. The first line, first yellow highlight line was the total from the end of 2020. And then the next three highlighted lines, we had our additions for the year, which that just added up in each category. You can see for buildings, we added $50,000 this year. That was our pole barn. We added improvements other than buildings at $15,000 for the parking lot. And then we added $70,000 in machinery and equipment for our truck. And then the only deletions we had this year, or reductions, was $25,000, and that was because we got rid of that Ford pickup truck. And I want to remove it not for the price that I sold it for, but for the actual historical cost amount. And so then that will come down and calculate to my ending balance for each one of the categories. And again, I like to have that just because that's the numbers that I have to enter into the AFR at that point. Now, all of that is necessary so that you can get a good handle on doing the accumulated depreciation calculation, which is what we're going to do next. So you can go ahead and change the slide. Okay, accumulated depreciation as of December 31st of 2020. This is the first time you're going to be doing this. So this is how I did it for the town of Toddville. I'm sure there are a number of ways that you can do it, but I thought I would offer this as an example. As Todd told you, we do not have a form for calculating accumulated depreciation, so I made this up for our presentation and example today. The first part of it is first few columns are just like the capital asset ledger, where we have the date of purchase, description of the asset, serial number, location, original cost, and estimated useful life, and date of disposal. Those columns are all the same here for as it was on the capital asset ledger. The next column that I put in was the yearly depreciation amount. That's just going to be your original cost divided by the estimated useful life of the asset. So for town hall, there its original cost was $400,000, and its estimated useful life is 80 years. So each year I'm depreciating that building by $5,000. The next line is years in service. And then, and so my years in service would be from 1964 to 2020. That has been in service for 57 years. In my example, I just, if an asset was put in place during a year, I counted that as a full year of depreciation, just so it would be a little easier. So then if you will take your yearly depreciation, which for town hall was $5,000, multiply that by 57, which is the years of service. Then under buildings, you can see my total accumulated depreciation for town hall is $285,000. Because accumulated depreciation then would be your yearly depreciation times your years of service. Okay, next slide. Okay, I already talked about town hall, so we don't need to talk about that one anymore. But if we go down to the pickup truck, works the exact same way. That Chevy pickup you see there was original cost of $40,000. I had estimated useful life of 10 years. So my yearly depreciation amount is $4,000. That particular truck we've had for 5 years now. So if you follow that on over, the accumulated depreciation on that truck as of December 31st is $20,000. And you can follow the same thing with our Main Street, $2.5 million with an estimated life of 25 years. So my yearly depreciation is $100,000 multiplied by the number of years in service. My accumulated depreciation total for Main Street is $200,000. And similarly with that Dodge pickup at the end. And you can see how all of that flows over then to total accumulated depreciation. Next slide. I also wanted to cover a couple of other examples here for the fence and the Ford pickup. Notice that those estimated useful lives for both of those assets is 10 years. And notice that we've had both of those assets for more than 10 years. So those two assets are fully depreciated. So my park fence, its original cost was $5,000. If it's fully depreciated, then my accumulated depreciation for that is going to be $5,000. And the same thing for my Ford pickup. If my original cost was $25,000 and it is now fully depreciated, then my machinery and equipment accumulated depreciation for that truck is going to be $25,000. Next page. And then to show you the pole barn, again, just to reemphasize that construction in progress is not depreciated. Also, the land for town hall would not be depreciated either, because land is not depreciated, neither is a construction in progress. Okay, and then you can see the total here. Just added all of those up so that I know how much my accumulated depreciation is in infrastructure, how much is in buildings, how much is in improvements other than buildings, machinery and equipment. I didn't have anything in books and other, and my total accumulated depreciation for all assets is $540,000. So that's how I arrived for the town of Toddville at the accumulated depreciation by type of asset as of December 31st of 2020, so that you have a base for your beginning accumulated depreciation for 2021. Okay, so we'll move on. So, because what do I do in 2021 now? Because that's the year we're in. You can do this a couple of ways. If you want to know what your total accumulated depreciation is at the end of December 31st, 2021, what I did with this chart is I kept the same one as before, except I changed the years of service. So now my town hall is not 57 years old, it's 58 years old. And I did the same calculation. I multiplied the yearly depreciation times 58 to come up with my total depreciation, accumulated depreciation for my town hall at $290,000. Next slide. Okay, and I'm still looking at accumulated depreciation for December 31st of 2021. And really, this is going to just follow the same thing we did for 2020 with the town hall and the fence and the other three assets there that are highlighted. Remember, I increased my years of service by 1, and then I'm just multiplying it by that yearly depreciation there. And we do have to keep in mind, for the fence and the Ford pickup that are fully depreciated, again, that depreciation is not going to increase. It's just going to maintain there at the 5,000 and 25,000. Next slide. I did want to point out in 2021, we got rid of that Ford pickup. And you'll remember on my capital asset ledger, I took the historical cost off. Well, on my accumulated depreciation schedule that I have, I also have to remove the accumulated depreciation associated with that asset. And in this case, my Ford pickup was fully depreciated, so I would remove $25,000 from that. And actually, all I'm doing there is I'm just showing 0 accumulated depreciation for that asset. Okay, and then on the next slide for 2021, I did have 3 assets that I added. Remember the pole barn, GM pickup, and the town hall parking lot. Those have only been in service for a year, so I'm for my purposes and my schedule, whenever it was added in the year, I'm taking a full year's worth of depreciation. So I'm multiplying yearly depreciation times years in service and coming up with that accumulated depreciation amount. So that will, you can go ahead and change to the next slide, I think, yeah. Those are my totals there across for December 31st of 2021. Now that helps you a little bit in that, oh, can you go back one time? That helps you a little bit in that you know now what your accumulated depreciation totals are for December 31st of 2021. And it's that $637,500. However, for the AFR, you really need your additions and reductions to accumulated depreciation, and you can't just net that. So there's a little bit more work involved. I did this schedule because I like to have a check of what my accumulated depreciation should be, so I know what these totals are before I go into the work of actually looking at the individual additions and deletions. But we'll do that now on the next slide. And I'll show you how all that works together at the end. Okay, this is the, all right, this is the slide I want to be on. Okay.
I didn't jump too far.
Okay, that's okay. They all look so similar, I got confused.
Okay.
Okay, so town hall. Oh, okay, I'm sorry, I lost my train of thought here. So for town hall, my addition for accumulated depreciation for 2021 is just going to simply be the yearly depreciation amount. So my yearly depreciation for town hall is $5,000. So you can see that in those individual categories under buildings, I put $5,000 because that is my addition to the accumulated depreciation for 2021. The same thing is for the Chevy pickup. My yearly depreciation for that is $4,000. So I put $4,000 as an addition to accumulated depreciation under machinery and equipment. And really the same on down. For Main Street, I'm adding $100,000 because that's my yearly depreciation. The Dodge is $5,000. The Town Hall parking lot is only $500. The GM pickup is $7,000, and the pole barn is $1,000. So all of those numbers, the yearly depreciation amounts, I have carried over to those individual asset types so that I can look at the additions for the year. The next slide. Okay, I did want to call attention to the fence. Remember that the fence is fully depreciated. So I'm not going to add any depreciation for that in 2021 because there is no more depreciation to add. It's fully depreciated. So you're going to have to keep track of those items that are fully depreciated so you just don't routinely add in the yearly depreciation amount. You wouldn't want to do that because then you would have more depreciation than your historical cost. Next slide. I also wanted to point out to you the Ford pickup that we sold in 2021. Remember that I am removing the amount of accumulated depreciation associated with that asset. In this case, it was fully depreciated. So I'm going to remove all $25,000 of accumulated depreciation as a reduction in accumulated depreciation for 2021. And I'm going to show that in the machinery and equipment section. So next slide. Okay, good. All right, so now all I want to look at on this page then is the totals. Because remember, this is the additions and reductions. It's not total accumulated depreciation yet, but that's what I'm going to do down here in the gray area. So that first line, beginning balance 1121, that's what we figured before. And I had a total accumulated depreciation of $540,000. In 2021, you can see the additions there. The $100,000 was from the street. The $6,000 was a combination of town hall and the pole barn. The $500 was from the parking lot, and the $16,000 was a combination of those three vehicles. So those are my additions for 2021. And then the reduction, the only reduction I had was the one pickup truck, and I took out $25,000. So on my schedule, I did a beginning balance, I did my additions, I took out my reductions, and I arrived at my ending balance, which is $637,500. But I also have a total ending balance for each type of asset, which you're going to need on the AFR. So I know what my total accumulated depreciation and additions and reductions are for infrastructure, buildings, improvements other than buildings, and machinery and equipment. So on the next slide, I just wanted to show you, we've been through both of these. This is not new. But that first slide was for 2021. I just went through and multiplied the yearly depreciation times the years of service so that I could know what my accumulated depreciation was for each in total and for each type of asset. In the second schedule there is where we went through and actually looked at each individual addition and reduction to capital assets by type of asset. And that also comes down to that $637,500. So I have a comfort level that that's right. You don't have to do that first schedule. You can just do the second one. I just happen to like to know to have some, comfort level there that I have the right number. Kind of a double check. Okay, so we went through all of that, and now we have the AFR that we're going to have to deal with next year. And this is what I have been told it is going to look like. So you'll be entering your land there at the top. You'll start with your beginning balance, additions, reductions, and ending balance. Same thing for construction in progress and other non-depreciable assets, which perhaps that would be artwork. Those are all three at the top because those are not depreciated. Then in this next column, there's going to be depreciable assets, and you'll have infrastructure, buildings, improvements other than buildings, machinery, equipment, and vehicles, and books and other. And you will go ahead and enter all of your totals there from your spreadsheet to arrive at your ending balance. And then at the bottom, you'll have accumulated depreciation, which notice you have to have by type of asset. So you do have to know, like, for example, infrastructure, what your beginning balance is, your additions and your reductions, and your ending balance. You'll have to do that for all asset types. And you'll also have to do that for each government activity that you have. And then this is the capital asset note that will be in the financial statements for 2021 and after. And that, again, is just going to mirror what you entered into the annual financial report with your assets that are not depreciated at the top, then your depreciable assets, less your accumulated depreciation at the bottom. So that's all I had in the way of an example. I hope that was helpful. Todd and I can now just open it up for questions, I think.